Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from U.S. tax reform 2.0 to the EU's latest developments. I'm Doug McHoney, PwC's U.S. International Tax Services leader. You can watch these podcasts on YouTube at youtube.com/Doug McHoney. On this week's episode of Cross-Border Tax Talks, we're back in PwC's Policy on Demand studio in Washington, D.C., where I'm excited to be joined by Puneet Arora. Puneet is an international tax partner in PwC's New York City office and PwC's Financial Services Tax Consulting leader. Puneet, welcome to the podcast. It's great to finally have you on.
Thank you, Doug. It's always good to be with you, and this is an ITS podcast, and good to do it with you.
Yeah.
It's the first one.
Well, maybe before we dive into some of our technical material, and I'm particularly interested in getting your particular industry's insights related to some of the latest developments, and we're going to spend most of our time on ATAD 3. But before we dive into that, I did have a particular question for you. In addition to being on the global and U.S. board of directors for PwC, you're also a board member for an organization in New York City called Streetwise Partners. Very interested. Can you tell us a little bit about that organization and what you enjoy about participating as a board member there?
Thank you, Doug. Thanks for asking that question. I've been on that board of Streetwise for 5 years now. It's actually an organization that was started by PwC alum. A lot of people don't know that. It is an organization that is focused on soft skill building, helping children and people from underprivileged sort of neighborhoods develop soft skills as they enter the workforce. What is so inspiring to be on that board is it's a very grassroots level organization touching 3 offices actually: New York, Washington D.C., and Michigan, Detroit and Michigan. And so they do 6 to 12 week programs where they will help mentor people who are looking to enter the workforce. And literally hearing the stories of how the program changes people's trajectory in terms of entry into great positions. Some of them are at PwC, actually, I'm very proud to say.
Neat.
Is really very touching, and it's something that every time I'm at one of the meetings where I hear a story or I get an email, it blows me away. It definitely is one of the reasons that keeps me smiling all day.
Fantastic. All right, well, let's turn to the technical material at hand here. I wanted to start with the latest anti-tax avoidance directive, referred to as ATAD 3, that was issued by the European Commission on December 22nd, 2021. We had a very busy end of December. I'm still getting all the podcasts in after Pillar 2, the foreign tax credits, and this is last but certainly not least with respect to ATAD 3. And what I wanted to point out to our listeners is that it is relevant for all companies and industries. But I think it's particularly important for the financial services industry, as many times legal entities are used as investment vehicles for shareholders. And I think sometimes this concept and the use of the term shell entity is really a pejorative type of term where you need to come up with a legal mechanism for investors to be able to pool their resources and their capital to then invest. So maybe let's start with what is ATAD 3, what is the point of this, and really, why is it important not just for financial service entities, but really all companies that have holding companies or otherwise use investment vehicles?
Yeah, so let's get right into it. Timing was quite unique. Like we were expecting something like a TCJA, like with BBB coming around the same time, and everyone was preparing to cancel their vacation plans and look at some new U.S. tax legislation. Instead, we got this, and it really did come. It's not completely as a surprise because there had been some consultation during the course of 2021. There were the Danish cases, as you recall, where the concept of beneficial ownership was introduced, but there was a whole focus on shell companies and whether there is a misuse with respect to those shell companies. And so this really does target the use by taxpayers of shell entities. And it is perceived as being purely tax driven and getting a tax result which would otherwise not be available. So I want to go back to what you started with, which essentially is like, why are these entities used in the industry? And you very correctly summarized it and saying it is a pooling vehicle. So if you look at investors, they are actually in jurisdictions and paying full tax with all the reporting, that is we've seen come in over the last few years. It's not that any of that is hidden away. It is frankly fully reported. In fact, to get better tax treatment, they are picking up income on a current basis in some cases. And so this whole perception that somehow these quote unquote shell companies can defer or eliminate tax is somewhat misplaced, but this is where this is going to. And in a way, like as this gets fleshed out, those issues will become more clear. So let's just sort of touch on how does that impact our industry. In the industry, there are commonly used vehicles, for example, in Luxembourg, Spain, the Netherlands, and those are all jurisdictions which are used because they are, full exchange of information. There is a good infrastructure set up for setting up of funds, which is in all the administrators and the like. So it's set up principally for that reason, not
good legal systems.
Exactly, very tested legal systems. And for a number of investors, they have governance issues with respect to investing in jurisdictions which didn't have a good legal system or didn't have full exchange of information. And so these jurisdictions have been picked. So when you look at this particular development or this proposed directive that has come in, and it has to go through a process which we'll talk about, it doesn't necessarily tie into some of the other efforts which are underway for the industry, but it is an important one for us because absent getting through, and we'll talk through some of the details, it does open up for more disclosure with a negative connotation, which then puts more controversy, more denial of legitimate benefits that are available. I will say there is the timeline for it, which is January 1, 2024, with the expectation that first it has to go through and legislated at the EU level, then it needs to go to each country to adopt it, and then effective. So a few things have to happen, but it does have a 2-year look back from the time of. So we could potentially be looking at something which is currently relevant to the industry.
Yeah, and that's really important. And we'll talk a little bit more about that. But yeah, the rules aren't actually effective until January 1st, 2024. But because of the nature of the look back, kind of the activities that are taking place, and we'll talk about the gateways and some of the carve-outs, but that is relevant today, even though it's not effective for another 2 years, because we're going to have to look back here to 2022 to really understand what was taking place to figure out whether we're in the soup or not.
That's absolutely right.
One other thing before we dive into some of the carve-outs and we get into the gateways, because I think it's a really important point that you mentioned, Puneet, is that the perception, I think, and I think this is frankly outside of tax, and I think most of our listeners are pretty wonky tax people like ourselves, but the number of conversations that I've had to have with non-tax people to understand that the use of these types of investment vehicles or holding companies is not about hiding things, right? There are very specific rules and regulations that all companies, whether you're a big public company, a big private company, whether it's a financial service type industry, that companies have to follow rules specific rules with respect to reporting, where they have bank accounts. To your point, from a tax perspective, we've spent a lot of time in the cross-border tax talks. We talk about subpart F, we talk about GILTI. We don't spend as much time talking about PFIX, but there are very specific rules, particularly for U.S. investors, that your point was that the investors are paying tax. They're not using these respective legal entities, right, as a mechanism to avoid tax, because ultimately they have the tax liability at that investor level. And that's not just for U.S. investors, right? Other jurisdictions have very similar rules, whether it's similar to our CFC, Subpart F, GILTI rules, and PFIC rules, and similarly, that all of that ultimately gets reported at the investor level.
You're absolutely right, Doug. And fundamentally, if you look back and say, what is the difference between a traditional financial services organization like a bank and the alternative side is, in the traditional space, it is that same potentially a public company, which has the people and the capital all in one silo.
Right.
All the alternative industry is doing is the people sit in one silo, which we call the management side of the equation, and then the capital sits right next to it in a separate silo. So it's just doesn't have that umbrella organization, and that shouldn't itself cause as much concern as it is with some of the authorities around the world. It's a question of a slightly deeper understanding of what is driving that versus entities being there for the sake of deferral or avoidance of tax.
That's right. All right, so let's talk about, let's dive in a little bit deeper into the rules. And let's start with the carve-out. So there are some specific rules, some specific things where where a particular entity may be carved out before you even have to go, we're going to talk about the minimum substance test. So what companies, entities are immediately carved out from these rules?
So there are essentially like 4 categories where there is specific carve-outs, which essentially means that the rules don't apply.
Yep.
So the first is for listed companies. Now the question is, what is a listed, like how broadly do you define a listed company? Is listing a listing of some bonds, or do you need for all equity? Like that, we'll see how that plays out. There is a rationale for listed companies, but that rationale could equally apply to the broader interpretation like I mentioned. There is also an exclusion for regulated financial undertakings. So for example, certain regulated funds. But then the question is, are the entities below the regulated fund excluded or not, which we will have to see. But if you were going with the rationale that the regulated fund is excluded, it would essentially mean that anything that is there in that structure for the purpose of advancing the regulated fund should not be covered, but we'll have to see where that plays out. There's also undertakings that hold shares in operational businesses in the same jurisdiction. That's a fairly narrow category of carve-out, but understandably so. Like, so if it's a holding company in Luxembourg with a full-fledged operational company below it, so just that would make sense. And then it has at least 5 full-time employees carrying on the income-generating activities of. So again, it's very specific. The 5, how that plays out. But the question is mostly around those are people, full-time employees for driving that business. So that again is a narrower sort of carve-out. But those are really the 4 carve-outs.
And you're right. A lot of these beg more questions than they provide answers. Like to your point on the 5 full-time employees, they have to be income-generating activities of that undertaking.
Yeah.
And so, that it actually there's a lot of questions, right, as far as what are income-generating activities related to that undertaking. If it's an investment vehicle, and if you've got a portfolio of different operating companies. A lot of questions with respect to each of those carve-outs.
Questions are good, Doug.
Right.
That's what keeps you and me in business.
That's right. So if you don't meet one of those carve-outs, right, then you're kind of in the soup, and you have to go through this minimum substance test, is what they describe. And I think there's 7 the kind of steps that you have to go through. And the first is I think what we've been referring to as the gateway. Right, just figuring out to determine whether, are you even something that potentially has to report? So talk a little bit about the gateways.
Yeah, so thanks for bringing, you're ordering it in a way that is understandable. So the way we're going is, here are the rules. You can have specific carve-outs. You can meet or flunk the gateways, however you want to think about those gateways. And then you're still out. If you get past those 2 and you still, then you're still subject to the rules, and we'll talk about what happens then. So I just want to contextualize what these gateways are. So the gateways, essentially, the first gateway is 75% of the entity's revenue in the preceding 2 years must be from relevant income, which is passive income, or where income has not reached. Even there are some anti-avoidance rules which say that even if that income has not come to that entity but should have come to that entity. So again, this is, if you flunk this, then you would fall within part of those rules. So the geographic mobility, what we call the revenue threshold, is that 75% threshold. And then the other one is it's engaged in the cross-border activities. So either more than 60% of the book value of assets are located outside of the member state, or 60% of the undertakings relevant income is earned or paid out via cross-border transactions. Again, the use of these holding companies typically is not to do business in that jurisdiction, and it's just for much broader. So again, to fail this test is not hard for the purpose which is,
Right.
but
Yeah, and that's common for both, whether you're publicly traded companies, I'm thinking for U.S. multinationals, as well as private equity or other investment funds. I mean, these are generally holding companies which hold a diverse set of international investments.
absolutely. So we then come to the third, and it's important that you, like I said, you have to fail all three in order to fall within the rules. So the first two are somehow, it's hard to get, to take a position. Otherwise, there may be cases, but like as a general matter. So the third is the entities have outsourced the administration related to the day-to-day administration and decision-making on significant functions to others. This is the part which is a bit tricky. And when we talk about gateways and when we talked about the 2-year look back, it's taking stock and saying how much of these activities are outsourced. And what does that mean with respect to that outsourcing of that activity? So, is this where you have directors who are professional directors who have the capability and the skill set to be directors, are those now excluded from consideration with respect to the administration? Like when you talk about the day-to-day administration, how far do you go? Do you talk about operational or governance alone? And so there are a lot of questions around this third gateway in particular. And I think the need to actually hone in on that gateway and understand the footprint and what is going on right now is important, because there may be things that you can do to make sure that you don't fail this third gateway and fall within the rules.
Yeah, and having external directors is very common, right? Both for U.S. U.S. multinational, I mean, for the work that you're doing as your charitable organization, right? I mean, having these external directors, I think, is something that's very common. And obviously, just being mindful that you don't end up kind of in the soup here as a result of having some external directors for any of these legal entities.
Yeah, there's one other thing which I'd want to mention here is when you think about all the other things that are going on with respect to MLI and the beneficial ownership, the principal purpose. So you're in fact trying to establish that these entities have a purpose other than tax.
Right.
They are in fact legitimately representing good investors, may not be in the same jurisdiction, coming in through those entities. And so this is not entirely disconnected from that exercise.
Right.
So when you look at it, there are common threads in those. And so when you start to prepare for it, and I know we'll talk a little bit later of what that means, and where we see all of this headed, I think you want to take a holistic view and sort of put that all together and say, what are the operations? What are we doing around it? What is the infrastructure? Is the infrastructure commensurate to the operation? Because again, to manage an entity that is managing investment, like you don't necessarily need as many people as a manufacturing unit or a research unit. And so those questions are still open. The other question that is open is going back to like the model where the people sit on one silo and the investments are coming. If you don't make those connections and say, well, those people are there, they're just sitting in a separate entity, and you impose all these restrictions on the entity that through which the capital is flowing, it shows a lack of understanding of why the two are there.
Right.
But that necessarily just puts you in a place where it's harder to meet the gateway, even though commercially speaking, there is a good rationale for those to exist in separate entities.
Yeah, and I think that's what makes it a little bit more challenging for the financial service industry, potentially compared to, the publicly traded companies.
That is correct.
So, all right, so if you're in the soup, I like your perspective with it. I'm not sure if you meet the gateways or you fail the gateways, but let's just say, we'll say if you fail the gateways and you end up in the soup, what are the consequences? So you have to report in the annual tax return, and maybe before we get to the actual consequences, you have to report that in your annual tax return. There's a presumption of lack of substance, but there's also an ability to be able to potentially rebut that presumption. So it's kind of a little complicated the way they structured these rules, but like if you meet the gateways, you can still potentially rebut the presumption about that there's not a lack of substance. So tell us a little bit about how that rebuttal might work.
Yeah, so we can talk separate it out between the rebuttal and the consequences, but let's talk about the rebuttal and the exemption route. So if you are if you fail the gateways or flunk the gateways as I call it, then you have to now, then the reporting is just, is
You
there.
have to report.
Yeah, so now the question becomes, how do I rebut the presumption that I'm not a good resident? So to your point, I may not get a tax resident certificate, or I may get it with a health warning saying there's not. So I'm able to now demonstrate, I have the ability to go back and rebut that and say, no, I do have enough substance for the purpose of what, for the activity that I'm carrying on. And I can apply for an exemption. That starts to feel more like a ruling process.
Right.
And so now we moved away from some of those and said, let's have established rules so there's clarity. And now you're coming back into by entity going for it. And what does that time lag actually mean? Because sometimes when we're launching a new product, we have to think through a lot of distribution issues and other commercial, operational issues. And tax is sort of making sure that nothing that they're doing is going to go sideways in terms of what we cannot do or what we cannot report, so what the investors would want. And now suddenly you have a requirement to go and get this ruling in order for this product to be even viable. So this puts a lot of delay, it puts a lot of administrative burden on those countries where you would need to apply it. It puts a huge burden on the industry to go entity by entity, seek clarification and provide specific evidence with respect to being able to rebut that. So it seems like it's in spite of all the transparency that already exists in the reporting and that is coming through, this is going to put more burden, and it's not entirely clear what it is achieving.
Yeah, I'm with you, because you wonder, because there certainly has been a trend in the industry to move away from rulings, right? And we've certainly seen policies, right, that have been enacted by the EU and the OECD, and sharing of information and just general kind of approaches from taxing authorities in Europe and elsewhere to kind of move away from the ruling process, to your point, to have very specific rules that everybody's subject to, and to kind of stay away from the ruling process. And this is moving right back. That was exactly my thought when I was going through this, was that how are the various countries' tax administrations going to be able to handle the sheer volume of potential rebuttals that you want to go to? And then, to your point, if there is an investment, if there is a fund that has a whole series of various of different investment vehicles, depending on, to your example, different products, or there's any number of reasons that you might set up various investment vehicles, presumably, at least my read, well, that needs to be done on a legal entity by legal entity basis. Right. And and it also goes back to the point of the carve-outs. Presumably that just applies to the parent entity. Does it tier all the way down? But it just seems like a really heavy burden, both for taxpayers as well as taxing authorities, to be able to manage that rebuttal. There was also, in addition to the rebuttal, there's also an exemption for the lack of tax motives. What does that mean?
Yeah, it's the exemption, the entity must be able to show that it doesn't reduce the tax liability of the beneficial owner or of the group. And that sort of puts the subjectivity involved in that is like, how do I prove that? And then even if I prove it and it's reported, like the source country is going to ask me again. So it's essentially saying, yeah, you can rebut it because the whole purpose was that you were somehow saving tax, and if you can show that you were not, then perhaps you can. So there is that, but it the way we'll have to see how the specificity in terms of the process and each country requires, but like essentially to show that you've not reduced tax as a group or as an entity.
Yeah, I mean, and it appears that they want companies, investors, just to take tax out of the equation completely when they're making investment decisions. And I think sometimes we need to remind people that tax is just one of many expenses that investors look at in making decisions, making investment decisions. It's a cost, right? And to try to imply that investors can't look at tax as far as making investment decisions is a bit of a head scratcher.
Yeah, and also with MLI, if you already have principal purpose,
right,
what is this additional process actually achieving? It's unclear right now.
Yeah, to your point, the multilateral instrument, generally when that was enacted by a number of countries, the U.S. did not sign on to that, but it has a specific principal purpose clause that tax cannot be a principal purpose for setting up the legal entity, or you cannot avail yourself of the treaty. And you're exactly right. This seems to be on top of that. Like that rule appeared to be, and it's going to be enacted well beyond the EU. To remind listeners, this applies. This was the European Commission. We're talking about the EU here, and the MLI is much broader than that. All right, so speaking of which, what are the consequences? So you had already mentioned that a company, if they fail these rules, can't meet the rebuttal or can't get the exemption, that there's no residency certificate, right? So they can't get a residency certificate. What are some of the other potential consequences?
So you will not either get a tax resident certificate, or you'll get a certificate with a warning statement, prevents the use for purposes of claiming relief from double taxation. This could give you could be denied the benefits of the EU directive.
Yep.
Because
so interest, royalties, the parent subsidiary dividend
correct.
withholding.
Yep. So those are very. So whether it's any sort of measure within this parent subsidiary directive and the interest and royalties, as you mentioned, and because of the reporting, it also puts scrutiny with respect to each of the source countries, whether or not you met any of the rebuttals or been able to get an exemption. Now the reporting will trigger more of that scrutiny and potentially audits. The one other thing that is there is a CFC type right over the relevant income of the shell company, where the shareholder and the entity are within the EU. Mm-hmm. So the shareholder would pick up that income, which is perceived to be the relevant income, on which tax is not paid at the quote-unquote shell company level. So there is that, phantom income pickup sort of CFC type concept built in as well.
Yeah, and just to reiterate a couple of those points. So this only applies to EU entities, right? Third-party countries, not relevant. But if you have a Dutch company that owns a Spanish company, just to pick two, and then the Spanish company runs afoul of these rules, then it appears as there's another type of CFC inclusion type of regime that would say that the Dutch company could pick up the income of the Spanish entity. So kind of another layer on top of it. We're going to get to Pillar 2, just another layer, and the income inclusion rule, just another layer of CFC income taxes.
I mean, for right now, it does, as you rightly pointed out, applies only to EU. But some of these themes, as you know, have been picked up by other countries as they've. Not to mistake that this will, just stay confined to the EU. Like this directive, yes, but the themes of this directive could potentially, if in the future, be adopted by other countries. So we just have to stay on the lookout and make sure there's a level of scrutiny around it.
It's a great point, Puneet. And if we can we don't need to look any further than ATAD 2, yep, right, which was the anti-hybrid rules. Those anti-hybrid rules were enacted by the EU, right? They actually came out first, and then as part of the TCJA, right, and here in the US has enacted anti-hybrid rules. Canada has proposed some anti-hybrid rules. And so you're absolutely right that we've seen from if prior performance is indicative of future results, right, what has started in the EU could very much spread, yep, to the rest of the world. I think it's a really, really great point. I think one of the other consequences worth noting is that it does require an exchange of information by EU member states. And I mean, this is a common trend that we're seeing, obviously, in tax, in particular with the EU. So all this information will be shared, right, amongst the various EU member states and jurisdictions. So Puneet, let's go back to the timeline and for adoption of this. So it's January 1st, 2024 is what the proposed effective date. But there are a number of procedural things that need to take place, both with the European Commission, the member states, and then each of the respective member states. So how does that process work?
So the proposed directive is initiated by the European Commission. It still has to go through a legislative process and reach unanimous consent amongst all EU member states before the rules are fully agreed upon.
And if the ATAD 1 and ATAD 2 is indicative that they surprisingly got all EU member states on board, because it does require unanimous consent, and then obviously it has to be adopted in each respective jurisdiction. But obviously certain jurisdictions may be more impacted than others, but it seems that there's enough political pressure that at least the headwinds seem that everybody's going to adopt this type of rule. Yeah,
you're absolutely right, Doug. I mean, there was a statement from the Luxembourg Finance Ministry. They said that they may have been overstepped the mark. But if you look at the overall sentiment in Europe, and the directive is to avoid tax avoidance, and some of the other member states taking certain measures, the likelihood of that agreement is, to your point, if when you look back, it's likely that they'll come to agree on these rules. You then have, in order for these to be, then you need to be implemented through domestic legislative processes for each of the EU member states. So the directive has proposed that the national laws of the member state be in place by June 30th, 2023, and come into effect January 1, 2024. In a somewhat unusual step, they have asked for comments, the European Commission, but those comments, by the way, are going to be shared with the Council, the EU Parliament. So, it brings us, this is not a consultative process at the initial stage, which we had when they initially asked in May 2021. These comments are going to be shared much more broadly. So there is going to be more eyes and different sort of people at different vantage point and different sort of motivation sort of looking at those comments. So that's the process that this needs to go through.
Yeah, and it feels to me, Puneet, it's a fairly ambitious timeline. And I would call it even a fairly ambitious timeline if there wasn't everything else that's also going on, including Pillar 2, that we're seeing beyond the EU. And so there's just appear to be a whole number of things kind of in the queue, both with the European Commission, the EU, and then at each of the respective member states. Like, there are a whole number of really significant tax provisions that countries are going to need to look at. Again, ATAD 3, Pillar 2, and then we've already seen like Ireland and Switzerland, for example, say that they want to relook at their corporate tax regimes to get, to fit more in with the OECD's BEPS 2.0 or Pillar 2 framework. So maybe we transition away from ATAD 3, and we're going to come back to kind of ESG and how all of this fits in. But before we move to that, wanted to just touch briefly on Pillar 2, because we did a podcast on Pillar 2. Callum was here going through some of the detailed mechanics of Pillar 2, but really just wanted to get your insight, because we spend a lot of time, my focus is often on U.S. and non-U.S. publicly traded companies. How is Pillar 2 impacting the financial services the financial services industry? As we think about private equity and these alternative investment vehicles, what are some of the concerns and issues that you guys have been thinking through related to that industry?
Yeah, so I think Callum actually covered that really well on that. And for those who have not listened to that podcast, strongly encourage, because it's a very good foundational way to understand Pillar 2 when the two of you had that conversation. So just to sort of add to that, there are some, so again, when we look at the alternative side of the industry, there are three buckets that we sort of try to put things in. One is the management company side. Yep. The other is the fund side, which is where the investor entry point, those vehicles and vehicles below it. And then there is the investment side, which we often refer to in private equity as a portfolio company.
Right.
So the portfolio company is no different than what you discussed. Right. So that's just another company. It may not be public. It's privately owned. Sometimes, for preparing for the rules apply to those exactly how you discussed. And there's no industry exclusion as such in those rules, as Callum and you discussed on that podcast. What is different here is, as far as the funds are concerned, the sovereign investment funds, the pension funds, there is an exclusion with respect to those, because those are looked at as a pooling vehicle versus an enterprise in itself. And so there is a carve-out for those, with the understanding that this is mostly an intermediate entity going into the portfolio company, and that's where it needs to be looked at. I expect there's nothing in those exclusions which is offensive to policy, and so I expect those to be there. However, as things progress, and the scrutiny and what is coming through, there's always a possibility that people go back and look at it. I'm not terribly concerned about it, but it's certainly to keep in your rear view mirror in monitoring. As far as the management company is concerned, there you sort of look at it again like any other. That's a service business. However, it's no different than how it falls within the rules. And a lot of these big managers are managing a fair amount of capital, which triggers a lot of fees. And therefore, the question is, in that financial consolidated group, do you get to the threshold? And so a lot of them don't meet that threshold requirement, which is similar to the CBCR requirement. And if you don't meet the threshold, you're out. But that's, again, consistent with policy. They were trying to touch on the large enterprises, and still you're that large. The only thing of caution there is those bigger enterprises now are also doing balance sheet investing. And so you could end up, that those balance sheet investing may not be consolidated in order to provide breach that threshold. But there may be years in which you get returns, or there may be some income in a particular year where you breach it. Now there is a look back,
Sure.
So it's just a question of monitoring that CBCR threshold to see whether you'll get to that number. So some may just grow to be that, and we'll have to manage. However, on the management company side, I don't worry as much about it, is because they operate in high tax jurisdictions.
Right.
So if you look at the jurisdictions where they have most of the people, they are in, again, that business is based on where your people are. They are sitting in the UK, the US. And so this thing that we talk about, like, you may think the headline rate is enough, but it may not actually be enough.
Right. By the time you do the analysis on the deferreds and
Exactly.
everything else.
So that then you just need to make sure, once you hit that, is just to make sure don't take false sense of comfort that we operate in high tax jurisdiction. That the devil is in the detail in terms of the computation, and that I keep reminding people. You probably want to model it out and be prepared. But that's really
it really becomes a huge compliance exercise and
Absolutely.
burden, for across industries, right? And so your point is very well taken, that you have to do the math just to be able to figure out whether you're in or out of the rule, and whether it's just whether you can meet the threshold requirements, or if you can establish that you're operating in a jurisdiction after all these adjustments from a globe perspective at greater than 15%. So there's just a lot of work that is going to be demanded as a result of Pillar 2 from taxpayers.
And look, this is probably the right. I mean, it's good that you've been thinking about this modeling and created the capability in a group with use of the right technology tools to do this in a systematic, methodical way.
Right.
So we, shout out to that team, because they are sort of stand ready to be able to model this out and be prepared and do some scenario planning to see when you breach that threshold, so nothing comes as a surprise. Because if you breach that threshold, then you need to think about where your ETR is going to go, like what is really the impact. So again, the capabilities exist, and I thanks to your vision, like we've gone and gotten prepared for it, but it is a huge modeling exercise.
Yeah, it's a big modeling exercise, and particularly as you think about deals and as we talk about private equity, understanding what the footprint is of that target, and just simply modeling, as we talked about, like just modeling out a 15% rate for outside the U.S. is probably not sufficient anymore.
Yeah.
But so speaking of trends, where we talk about just significant additional compliance burdens, right? We spent a lot of time, and we've even had a couple of podcasts on ESG. And then specifically I want to focus on the G, which is governance. And as I think about ATAD 3, right, there's a big element of governance, right, that really I think people across industries are going to need to be focused on. But maybe we'll just spend a few minutes here wrapping up in, how did we get here, and then what are you seeing in the industry to try to manage this from a governance perspective? We already talked about there's going to be all this compliance requirements, but fundamentally governance is really going to be important to managing, frankly, this ATAD 3 as well as the myriad of these other rules.
No, thanks, Doug. As I was thinking about, spending the time with you, I thought about ATAD 3 in the context of, beneficial ownership, MLI principal purpose test, and then it's very easy when you step back and say, well, this all ties into where the ESG train is headed.
Yeah.
So if you, without going all the way too far back, but like just the momentum over the last 5 or 7 years has been significant. So I sort of was jotting down what are some of the key milestones that we've hit in the last few years, which tells you how this is, to me, feels like it's going to play out. 2015, we have the OECD initiative, introduces BEPS and provides CBCR, requirement to provide CBCR.
Feels like longer than 7 years ago, but it was
It's been a long 7 years.
It really has.
The last 2 years in particular have been longer than 2 years. So in 2015, Australia announces public disclosure of tax information. 2016, the UK requires publishing tax strategy. 2019, the Global Reporting Initiative, develops a new standard on tax, which includes some form of public, CBCR. This is 2019, right? Now we go to 2020, and the World Economic Forum International Business Council releases a set of stakeholder capitalism metrics and includes reporting of taxes paid as a core metric and taxes collected and paid as a recommended metric. You go to 2021, the EU agrees for public CBCR for large EU businesses with effect from 2024. Now you're going in 2022, what should you expect? Disclosure of ETR, right, of large EU businesses in the EU. What does that tell you? Like, CBCR initially was like, how are we going to collect the information? Who's going to see it? How much will we have to disclose to an entity? The train is sort of headed with full disclosure. This public CBCR is not too far away. So when you get to that point, like then you start looking and saying, as a tax professional in our industry, we really need to, it's not that there's anything to hide. It's a question of what story you're going to tell, and you cannot do it on the fly. So you need to have a tax strategy. And so, that has been more your world in terms of having a public strategy. And I can tell you, the financial services industry is not shy of having a public strategy. The question is, when you're committing to it, the way that business is structured and the reach and what they touch, instead of making an uneducated and uninformed sort of commitment on something, you want to be informed of what the implications are, so that in today's day and age, once you make a commitment, you must be able to collect data which is auditable by an external provider. It is correct. So when I step back and look at all of this, it is clear that ATAD 3 is another spoke in that wheel. You need to start to put that data together, have a uniform strategy, think about what the total tax is, total tax sort of contribution for that organization is, because then you can, instead of having a negative connotation to doing it, there should be here is the societal contribution as well. So we're not doing anything which is, running away with extra dollars or whatever the common perception, uninformed perception, would be.
It's a great point, Puneet. And I think that all of us within the tax profession, frankly, can do a better job telling our story. That our clients, taxpayers, whether you're an advisor, whether you're working in an industry, I don't care whether it's financial services or in a public company, fundamentally our jobs are to comply with these rules, and they keep stacking more rules on, more compliance. But I love the point of being able to tell the story, right? Because I think oftentimes, as we started the discussion, there's some misinformed views, particularly outside our industry, why we use certain legal entities, certain jurisdictions, certain investment vehicles. And really telling our story, I think both at the company level as well as at the advisor level, and really educating people that fundamentally we want to be able to comply with these rules, and frankly, it just gets ever more challenging as the layers of paint keep building.
Yep.
So Puneet, thank you very much. A great discussion, and really enjoyed having you on the podcast.
Thank you for having me, Doug.
So thanks for tuning in to this week's episode of Cross-Border Tax Talks. Thank you, Puneet Arora, an international tax partner and PwC's Financial Services Tax Consulting Leader. I'm Doug McHoney, PwC's International Tax Services Leader. Stay tuned in 2 weeks for another exciting edition of the Cross-Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.